Hey, this is Tom Nash, and unfortunately, 99% of investors in the stock market right now are looking in the wrong direction, in the opposite of where they should be focusing on. And Snowflake and what happened with Snowflake yesterday was a prime example of exactly that. Now, yesterday, Snowflake delivered subpar results, and that's fine, that happens. Now, I personally don't invest in Snowflake. I don't have a long position, I don't have a short position. So I got no skin in this game. I couldn't care less. But what happened with Snowflake raised a lot of questions from investors. Here's the thing. I think Snowflake is a terrific example, number one, of one simple principle, which I've been talking to you, I think, for 3 or 4 years, which is the time in the market is the best friend of a great business and the worst enemy of an overhyped, overvalued company. And I think Snowflake is a great example of that because Snowflake is not a bad company. In fact, Snowflake is a pretty good business and they will keep making money for a long time. They got a really good service. But I think that Palantir versus Snowflake really shows you the difference. While Palantir took a beating initially, but over time, the market realized what the fundamentals are and what the company actually has. And with Snowflake, I think the opposite kind of happened. People thought that this is going to be the next big thing. Obviously, Warren Buffett hype played a lot into that. The Microsoft stuff they got going on, all this stuff. And Snowflake, that was the darling of the entire investing community, basically did 15% after the latest pullback in a year. 15% a year. At the same time, Palantir gave you 217%. So, again, companies start out with different expectations, with different hype. You have a lot of examples. Palantir took an initial beating because of market sentiment. Snowflake rose to new highs. But at the end of the day, the reality cannot be cheated and cannot be lied to. While Palantir created a moat, a complex business model, and a sticky business, Snowflake really just sells a commodity, a great commodity. They're selling database, storage, stuff that has a very low entrance barrier, stuff that can be easily copied, and stuff that are commoditized. So you do have a lot of clients, but there's no stickiness there. Now, I'm not against selling commodities, not at all, but I'm saying that, Palantir is now being valued as what it really is, which is a company that's revolutionizing the way people use AI in their businesses. While Snowflake, on the other hand, is getting priced downwards because they're a great service provider, but they ain't Palantir. And now let's get to the interesting question, the one that you've been DMing me about nonstop. Is this the end of the bubble? Is this the end of the AI hype? And the short answer, just to give you the bottom line, is no. There is no bubble. It's not the end of the bubble. It's not the end of the AI hype. But wait a second. It's a little bit more nuanced than that. Allow me to explain. If I look at objective metrics, such as the greed and fear index, right? We're currently between greed and extreme greed, a little bit over to extreme greed. So it's not as bad as it used to be in the greatest crashes we've seen, but it's getting there and it's getting a little bit overheated, a little bit overexcited. And that shows me a correction is needed. A little bit of a pullback, a little bit of a correction. Now, if you look at the Buffett indicator, we're currently at 184%, which means market cap to the total GDP of America is 184%. So again, higher than the average, about 50% higher than the average, which shows me again, a correction, a pullback is in order. Now, the real question is not about whether the correction will come, because it will come. It's a certainty that there will be a correction, there will be a pullback. In fact, there may be a few. Every single year, we're seeing multiple pullbacks, multiple corrections. It's just a normal thing. The question is, will one of those pullbacks become into the .com level cataclysmic crash that's going to destroy households and create a lot of divorces? Let's put it this way. Now, I don't think so, although anybody who is predicting the future by definition may be wrong, and I accept that, but it doesn't seem like it. And let me explain why. Now look at the PE ratios right now. The PE ratio for the S&P 500 is on average 25. It usually where it kind of levitates around over the past 20, 30 years. We had some spikes. For example, we went up to 45 in the dot-com bubble. We went up to over 100 in the subprime 2008 crash. We're currently at 27, 28. So we're a little bit higher, but nowhere near the highs of the 2000 and 2008 crashes. So that's one thing you should consider. Now, the other thing you should consider is that the market really hasn't done anything for the past couple of years. In December of 2021, the S&P 500 was 4,700. Right now, we're back to 5,000. So we did 6% since December of 2021. So it seems like a huge run-up just happened, and it did, but don't forget that we have dropped a lot over the past couple of years. So On a zoom out kind of analysis, yes, we're up a little bit, but we're up 6% since the end of 2021. Nothing huge, nothing to get overly excited or fearful about. Now, look, stocks have good earnings. 70% of companies right now beat earnings. We have good fundamentals, good ratios. Nothing is out of the ordinary. Nothing is hella expensive right now. Not even Nvidia is crazy expensive, trading at 70 PE and half that for forward PE. Now, we also have the Federal Reserve essentially thinking and trying to decide when they will deploy a more accommodative monetary policy that is bound to push the stock market a little bit up. Now, they may do it in Q4, they may do it in Q1 of 2025. I don't really know, but that's another catalyst that's coming to the market. There's $6 trillion of money parked on the sideline right now that have not yet been deployed, which again will boost the market upwards. And at the end of the day, the most compelling argument for me is that AI, artificial intelligence, is real. Right now, I'm looking at all these companies that are really good at AI, and I'm seeing massive, massive cash flows. This business makes money. And I'm seeing massive, massive revenue growth and profit margin expansion. So basically, the businesses are producing a lot of cash and a lot of growth and a lot of profitability. So this isn't really comparable to the dot-com craze because these are good businesses and they continue to expand. The demand is there, the supply is there. So I don't think we're looking at a cataclysmic collapse of a that's the future, bro idea. I do think, as I mentioned before, that a correction is definitely in order. There's going to be a pullback. It might even be violent. Don't forget that even if the market pulls back 10% on the index, all of your growth companies will pull back 20 to 30%. That's just how things work. Now, there's really one way to kind of handle this because, you can't really time this market. Everybody knows that a correction is coming. Nobody knows when. I know you may go on TikTok and there's a lot of people predicting about when exactly, July and August. Nobody can really tell when this is going to happen. In fact, nobody really can tell if this happens in 2024 or maybe 2025. Who knows? If you sit out right now, you may miss out the rest of the rally. And if you get out now, you may not be able to get back at reasonable prices and have to go back at double what we are right now. I don't know. Nobody knows. So since we don't know the future and there's no way for us to find out how this is playing out, well, there's only one thing to handle this. Number one is accept turbulence. Understand that things are going to get hectic and sometimes you might see a lot of red in your portfolio, maybe even 30%. And number two is make sure that you've picked winners and not losers. Make sure that the stocks you have in your stable are the ones that will be the winners in 2033. Don't look at the hype. Don't look at the P ratios. Make a decision whether Tesla is going to be the leader in AI humanoid. Whether Palantir is going to be the most important software company in the world. Make a decision whether Nvidia is going to be the best AI hardware company in the world. These are the things you should be looking at. Make sure that your portfolio has those winners for the next 10 years and just dollar cost average into them, as I've mentioned before a million times. Dollar cost average means buying a little bit every single month and buying a little bit more when the price drops beyond a certain level, buying a little bit less when the prices are a little bit exuberant like we have right now. But no matter what you do, please, please, please don't try and time this market no matter what other experts have told you. Trust me, the only way to get out of this is holding on, being strong, picking the right stocks, and being patient and accepting that pain and blood on the streets will happen. Now, a few announcements before I let you go. Number one, stock MVP. You don't have it yet? What are you doing? 1 week for free. Try it out. Do it on DCF models. Make sure you're doing research. This thing doesn't work if you don't think for yourself. Stock-mvp.com. Try it out for a week. Join our academy. Patreon.com/Tom Nash. Would love to see you there. We'll teach you how to do your DCFs, how to read financials, how to become a better investor, how to actually think for yourself for a change, unlike what mainstream media is teaching you. And obviously, you're welcome to join our Discord, discord.gg/Tom Nash. It's free to join. You can hang out with us, talk with us, chat with us. We'd love to see you there. Almost 8,000 members already. So goodbye. You're missing out on a great party. We'll see you in the next one.